Since it was first launched in 2008, the Opportunity Crudes conference held in person biennially has been well praised by our upstream, midstream, and downstream colleagues. Unfortunately, due to the COVID-19 pandemic, we had to postpone the 2020 in-person meeting. However, we've decided to take advantage of the opportunity to turn this postponed meeting into two parts. The first part is a virtual event, via Zoom, from October 25th to 27th in 2021 to address uncertainties related to the pandemic recovery and increasing calls for decarbonization. The second part is an in-person and virtual meeting from October 24th to 26th, 2022 and will confirm strategies and technologies during these changing times going forward. The global oil industry is entering into an uncharted territory because of challenges from the pandemic, oil price volatility, and climate scrutiny. The question is, how can refiners navigate an evolving business and at the same time stay profitable in the near term and sustainable in the long term? In this year's meeting via Zoom, we assembled a team of hands-on business strategists and technology experts to prepare the industry to better navigate an evolving business. The 2.5-day meeting addressed 5 major themes in the refining transition. Session 1. October 25th morning session. Global oil and refining market outlooks. This session provided a look into impacts and implications of geopolitical tensions, OPEC plus dominance, demand peak accelerated by the pandemic as well as emerging carbon-neutral offset crudes, and business sustainability. Session 2. October 25th afternoon session. Crude procurement strategies amid shifting crude market and changing quality. Speakers explored challenges and opportunities in oil selection and procurement, U.S. shale recovery, Brazilian pre-salt crudes, imports-exports, and infrastructure logistics. Session 3. October 26th morning session. Refiners' game plan, revamps, and technology requirements to tackle urgent issues. This session addressed urgent issues regarding the future of renewable diesel and bitumen production, refinery petrochemical integration, and crude to chemicals. Session 4. October 26th afternoon session. Operational improvements, data analytics and the Internet of Things. This session focused on the latest technologies adopted for improvements in operations and environmental footprints, meeting sustainability goals via refining efficiency and crude selection, for example, carbon-neutral offset crudes, crude quality monitoring, and optimization of renewable diesel production. Session 5. October 27th morning session. Crude management. Experts shared their knowledge in contaminant monitoring and control, fouling and corrosion prevention, and incompatibility and blending strategies. A complete agenda can be found by visiting www.opportunitycrudes.com/agenda21. The following presentation is by our keynote speaker, Mr. Guy Caruso, Senior Advisor of the Center for Strategic and International Studies in the U.S. The title of the presentation is Energy and Geopolitics. The landscape becomes increasingly uncertain. If you are interested in watching all the presentations and the Town Hall Q&A meetings from this conference, please place an order by visiting opportunitycrudes.com. Thank you for watching.
Is a senior advisor in the Energy and National Security Program at CSIS. Prior to joining CSIS, he served as administrator for the U.S. Energy Information Administration, EIA, from 2002 to 2008. The EIA is a statistical agency within the U.S. Department of Energy, providing independent data, forecasts, analyses regarding energy. Many of us are very familiar with the EIA and their reports. Prior to joining Department of Energy, Guy worked at the Central Intelligence Agency as an energy economist in the Office of Economic Research. He holds a bachelor's in business administration and a master's in economics from the University of Connecticut. And recently, in 2018, he was elected president of the U.S. Association for Energy Economics. So, Guy, it is a pleasure to have you kick off our meeting, and I'll turn it over to you at this point.
Thank you very much, Dennis, for that kind invitation, and to Tom Young for the allowing me to be here at the Opportunity Conference once again. I'm getting a message that says disabled participant screen sharing. Am I, do I need to do anything?
You should be able to share your screen. Donna, you need to make Guy a co-host, please. Okay. You now are co-host and you should be able to share your screen there.
Okay.
Looking good. Okay. And now get your slide set there. Your PowerPoint.
I don't know. All I'm getting is it says.
Yeah. Where is your PowerPoint slide set? Okay.
Yeah, I'm not sure.
Okay. Donna, are you able to share Guy's slides for him?
Yes. Can you? Let me see. Can you? Let's. Hold a second. Let me bring up for you.
Reasons. Wait a minute. I'm getting something coming up on my screen anyway.
Okay, I'd like to go. Go ahead.
If you have your PowerPoint slides,
all right,
on your screen, you should be able to share screen.
And you, how's that? Can you see it?
No.
You have to click share screen. Click share screen.
All right.
Go to advanced.
Share.
Advanced tab, not the basic. And then the first one is for PowerPoint. And click on PowerPoint. Select the file.
Yeah.
Hey.
All right.
You want me to do it?
Donna,
Yeah.
are you?
You want me to do it? Yeah, I'll do it.
If you have the slide set available there, it might be easiest for you to share them and just advance them as Guy directs.
Is this the one?
Okay, how's that look, Guy?
Good.
Okay, wonderful. I'll let you work the slides, Donna, and take it away, Guy. Thank you.
Okay, thank you once again, Dennis, and good morning, good afternoon, or good evening, depending on where you are. Ladies and gentlemen, it's a pleasure to be here at the Opportunity Crudes Conference. Once again, thank Tom and Donna for their hard work in putting this meeting together. The first slide shows that how deeply affected the pandemic has. Can you advance the slide, Donna? Okay. Shows how deeply affected the world oil demand has been by the decreased economic activity caused by the pandemic. We lost about 10% of world oil demand in 2020. We're making some headway in returning that demand number back in as we move into 2021. But clearly, the pandemic induced economic recession was the main factor behind this. And the next slide shows that the transportation sector was by far the sector most affected. And then within the transportation sector, of course, air miles traveled took the biggest hit with a 40% decline in jet fuel and aero demand in in 2020. Gasoline and diesel fuel, particularly in heavy trucks, also were down on average about 10%. All of those sectors have shown improvement in 2021. However, we're still well below where we were in the pre-pandemic period. The next slide shows, if you look at this in a three-phased approach, beginning in the winter of 2019-2020, saw a huge decline in consumption in that winter period, about 20% in demand. And on the supply side, it was pretty much of a standstill. So a combination of a 20% decline in demand with virtually little or no change in supply meant much of that oil that was produced during the winter of 2019-2020 went into inventories. As you can see in the bar below in the middle, we had a huge increase in inventories beginning in the latter part of 2019 and continuing through the summer period, spring and summer of 2020. And that put heavy downward pressure on prices. As has already been mentioned, the period of late 2019 and early 2020, we saw prices as low as $20 per barrel on a monthly average basis. Slight recovery of demand in the spring and summer of 2020 did push prices upward above $40 to about $50, and prices stayed relatively stable during the period through the end of 2020. The next slide shows the global both consumption and demand. Huge decline from about 104 million barrels per day on a global basis. Demand fell to about 85 million barrels per day in mid-2020, and production fell, but not quite as much, which meant, of course, we had increased inventories of crude and products during that period until recovery period started toward the end of 2020, and it's continued into 2021. The outlooks by most of the forecasters from either the financial industry, the IEA or EIA, all project continued growth in both consumption and production through 2022, and a substantial stock drawdown, which is helping to meet some of that demand. Again, not enough to take the pressure off price, so we've seen prices recover significantly in 2021, and we expect that would continue. The consensus forecast for 2022 is prices will stay in the $70 to $80 per barrel for Brent, perhaps even higher. That there's a great deal of uncertainty when it comes to the economic growth in a post-pandemic world. The IMF latest forecast is about 4.5% GDP growth, and that could push prices even higher than $80 per barrel in the short to medium term. The next slide shows how dramatic the change in inventories has been, with the dark line showing that by the spring of 2020, inventories on a global basis reached 85 days of forward supply, which is about 25 days above the historic average for days of forward supply, which is about 60. What we've seen since then is steady decline, steady withdrawal of inventories, both crude and products, until we're now back getting very close to that typical level where we would be about the spring and summer of 2021, and we expect that would continue. So inventories will continue to play an important, but that the rebalancing of supply and demand, as shown in the previous slide, has been accomplished because of the huge decline in the inventories that had built up during the winter of 2019-2020. The next slide shows that the liquid fuels consumption is starting to climb back in 2021. We're about 95, 96 million barrels a day as we speak, headed back towards the 100 and 104 million barrel a day total world consumption number that we saw prior to the pandemic in, let's say, the first quarter of 2019. This, again, great uncertainty here is the economic growth, as I mentioned, projected by IMF and other forecasters to be strong in the second half of 2021 into 2022. If that happens, it would lead to the growth numbers that are shown in the slide, the part of this slide that's on the right, going from almost a 9 billion barrel a day decline last year to a 5 million barrel a day growth this year. So not reaching the pre-pandemic levels in 2021, but getting very close to that in 2022, if indeed the economic activity continues to follow the pattern that is projected by the IMF and the World Bank. The next slide shows the production numbers, and we're again seeing the rebalancing of the market with growth in the global oil production from its low of just above 87 million barrels per day in 2020. And we see a growth of about 5 million barrels a day this year, much of which is OPEC countries. Non-OPEC continues to lag behind, and that is largely because of lack of investment that is caused by the lack of economic activity, by financial institutions being concerned about profitability in the upstream sector, particularly in non-OPEC countries, and particularly in the U.S. This is starting to make some recovery in rig rates and other upstream activity this year, but slower than some forecasters predicted. So the OPEC has picked up the slack by raising its output significantly as it manages the market, and Saudi Arabia, Russia, Russia has been cooperating with OPEC and has, after reducing production, is now back on an upward trend for production there, and we expect that would continue into 2022 with, again, OPEC being the main gainer of production in 2021 and 2022. But the next slide shows that the surplus capacity in OPEC countries continues to be quite large, as they had to reduce production during the steep decline in demand in 2020. As I mentioned, it was close to 9 million barrels a day, and most of the losers in the market share at that point were OPEC countries, and that even continued bit into 2021. But now, with the growth in demand projected for 2021 and into 2022, that surplus capacity among OPEC countries is coming back down. It's about 5 million barrels a day by the end of 2021, and could be even lower. But the next slide shows that a large part of that surplus capacity in OPEC is in Iran, and previously it had been in Libya. Iran, of course, has a lot of oil off the market as a result of sanctions imposed by the U.S. and EU countries, and that could change into 2022, but it's likely to stay relatively high. Libya's tensions, political tensions there have eased, and therefore about 1 million barrels a day of Libyan production is back on the market in 2021 after the numbers they posted in 2020. The key on Iran is whether or not Iran-U.S. negotiations over a nuclear weapons agreement can be restarted. They are put on hold by the new Iranian government just elected earlier this year, and they've decided to wait before resuming negotiations with the U.S. if indeed the negotiations were to be resumed and come up with a new arrangement, and the U.S. were to remove sanctions, at least some of the sanctions, we could see 1.5 million barrels a day of Iranian oil back on the market in a post-U.S.-Iran agreement era. Right now, the geopolitical analysts at CSIS and elsewhere do not expect that new Iranian government will come back to the table in 2021. Whether they do in 2022 depends on how desperate the Iranians are to get more oil back on the market and increased revenues. It's one of the great uncertainties about the outlook for production here is whether Iran comes back into the market in 2022. So if they do not, it just means that most likely the additional oil would be supplied by other OPEC countries, such as Saudi Arabia and Russia. The other impact on energy prices has been natural gas, which the next slide shows. Natural gas prices have increased dramatically. This one shows Henry Hub for the U.S. going from under $2 per MMBTU in mid-2020 to reaching over, at some points during 2021, we did reach $6 per MMBTU on a daily basis. It's now down to about $5.20 as of yesterday. The winter price will depend, as always, on weather, but most forecasters expect natural gas prices to stay relatively high in the winter of 2021-22, perhaps $4 or even more than $4 per MMBTU. Futures market expects continued upward pressure on natural gas prices. Again, lack of investment in the upstream sector in natural gas has also made less supply available and therefore driven upward pressure on price in the United States and in the other regional markets in Europe and in Asia. Europe and Asia have been affected by lack of investment and continued demand for gas to substitute for coal during a period in which countries try to meet their climate change goals. They've been taking oil and coal have taken a hit in the especially in the electric power sectors, where coal especially, but even in some countries, gas has been substituted for oil. In Europe and Asia, the LNG market has been extremely strong, as lack of investment in new supply has not kept up with demand for LNG, and we've seen skyrocketing prices in Europe and in Asia, especially on the spot market. In those markets where LNG is linked to crude oil price, price has not been quite as dramatically high as it has on the spot market. Most forecasters expect these high natural gas prices to persist through at least 23-24 period because of the expectations that supply investments in new LNG supplies will lag behind demand, and therefore there's even some retrenching of the substitution of gas for coal and gas in some cases for oil, especially in developing countries in Asia and to a much lesser extent in Europe. The IEA has recently added about 500,000 barrels a day to demand for oil in 21-22 because of this substitution of oil for gas under these very high prices under natural gas. The natural gas prices have also affected the refining industry, as many of you know. The use of natural gas as refinery fuel has gone up significantly in this country, probably from an average of $2 an MMBTU to over $5 an MMBTU, adding significantly to refinery fuel costs in the U.S., in Asia, and in Europe as well. The impact of natural gas prices has also been shown in the electricity sector, as shown in the next slide. This slide happens to show the electricity prices in the residential. The next slide, please. Yeah, you can see steady rise in nominal residential electricity prices in the U.S. In Europe and Asia, we've seen similar increases, even higher in Europe, so that electricity prices, in some cases, the EU's forecast for winter 2021-22 for their electricity prices is an increase of about 40% over winter 2021. So the natural gas is definitely affecting, the natural gas increase is definitely affecting other sectors as well. And we expect that would continue in the near to medium term until greater investment can be made in the upstream sector, particularly in the LNG sector, where there are new supplies are expected to come on only slowly during the 2022 to 2025 period. So expect continued relatively high prices for natural gas over the next near to medium term, up to 5 years. The impact on the U.S. as a oil exporter has also been very evident in these developments. In the next slide, it shows that U.S. has gone, as U.S. production has fallen from over about 12.5 million barrels a day in 2019 to below 11 in 2021, starting to come back a little bit. But as I mentioned, investments in the upstream, particularly in the Permian Basin and in the Bakken and region of North Dakota, have really been slow because financial institutions have basically soured on investments in fossil fuels, and particularly in the upstream U.S. Oil and gas, and starting to see improvement in that outlook. The other impact and the greatest uncertainty as we look in the longer term is the impact of environmental opposition to infrastructure builds in the fossil fuel industry. And the Biden administration has moved further towards the progressives' demand for trying to do what it can to slow down or even stop investments in fossil fuels and in infrastructure such as pipelines and other transmissions. This has definitely had an impact, and we will see as the major countries of the world meet, consuming countries of the world meet in Glasgow, Scotland next week at Conference of the Parties 26, a UN meeting to review the Paris Agreement and the goals of the countries to reach much decarbonized demand for energy, and many countries have pledged to reach net zero by 2040, 2050, and China has just announced reaching net zero by 2060. So we'll see what comes out of COP26. Could affect investments in the upstream as we look forward out in the next 20 to 30 years. The next slide shows how the U.S. has moved from being a large net importer of oil to a net exporter of oil in 2019. Now, during the lower production numbers and increased imports of petroleum and less exports of products, U.S. moved back into the net oil import column. That is expected to change as we look out in the longer term, as shown in the next slide. The EIA's latest outlook shows in their reference case, or what we call business as usual case, that U.S. production is projected to increase back towards 20 million barrels a day from the about 11 and a half to 11.7 where we're at about now. So under this business as usual case, which importantly includes existing policies and regulations, if these policies and regulations were to change, and most likely we're headed in the direction of less investment under new policy and greater regulation on fossil fuels, we could very well see that reference case dip down well below 20. It depends. But as of now, EIA's long-term outlook is that the U.S. would continue to be a liquids net exporter over the longer term. But I would say, as a former forecaster at EIA, that this is probably the most uncertain slide that you will see today because of the likelihood that policies will change, and we'll begin to see where the U.S. is headed, as I mentioned, by the results of the COP26 meetings next week and as time goes on. Much, of course, depends on where the U.S. is headed with respect to infrastructure build, which is currently being debated in Congress, climate change spending, which is also part of the larger Build Back America bill that the Biden administration is trying to negotiate with Senators Manchin and Sinema now. Right now, it looks like a lot of the climate change policies that were in that bill are being weakened, but we still have a long way to go before we see what actually comes out of not only that bill, but the future Biden administration policies. One of the next slide shows how difficult that, again, EIA expecting under all scenarios that world liquid fuels consumption would continue to grow. But again, this could change dramatically based on policies being discussed among those countries next week, and what happens with especially investment in fossil fuels, which is expected to be weakened by these new policies and by investment in renewables and other alternatives to fossil fuels. The next slide shows that what a huge difference policies can make, and this is the BP long-term outlook released earlier this year. Their business as usual case shows production staying fairly close to 100 million barrels a day in the near term, and maybe going down to about 90 million barrels a day. But under rapid change scenario in which the countries pledges to reduce carbon and reach net zero carbon emissions by 2050, it could decline. It could be, consumption could decline as low as 25 million barrels a day by 2050. This is probably an extreme and unrealistic scenario, but it does show you what the ambitions are of the countries that are discussing these policies and pledges and goals. But we're a long way from meeting those goals. And so far, the policies are a long way from right now. If the current policies were to stay as is, you would see that business as usual case up there in about 85 to 87 million barrels per day. We'll get some insight into that, as I said, next week. Next, let me leave you with a few key takeaways from my discussion today. In the near term, and by that I mean 2022 to 2025, the key impact on global oil market will be post-pandemic economic activity. That'd be the number one driver of demand in both OECD developed countries and non-OECD countries, especially the Asian developing countries such as China and India and others. You'd have anywhere from a 3% GDP growth to as much as 5% GDP growth if we get back on track as projected by the IMF. I would count on volatile oil prices for sure this winter 21-22 and into 2022 and beyond. And much of that depends again on investment in the upstream, particularly in the non-OPEC countries such as North America and others. The OPEC has still a significant amount of unused productive capacity. They could bring plenty of oil onto the market to balance the market in an era of steadily rising demand. But part of that would depend on Iran coming back in a post-US Iran agreement scenario. Natural gas prices, almost every forecaster expects steady high natural gas prices in all three regional markets, North America, Europe, and Asia. How long that lasts, difficult to say, but right now the consensus is relatively high natural gas prices, $4 to $5 in the US and much higher than that in Europe and even higher than Europe in Asia, certainly for the next 3 to 5 years and possibly even longer. So investment upstream is the key indicator, and we've seen some countries and even the IEA saying in order to meet carbon reduction strategy goals and the net zero aspirations of the OECD countries, there need to be a significant decline in fossil fuel upstream investments. Whether that happens or not is still, I think, one of the key uncertainties. OPEC and Russia cooperating would continue to manage the market, and I think they would probably be successful in holding prices in the $70 to $80 range for the next 18 months, perhaps even longer. Again, key dependent issues there: the global economic growth and investment in the upstream. Over the long term, climate policies and countries attempting to reduce investment in fossil fuel infrastructure will be the key to watch there. Whether there will be a carbon tax enacted in the United States, still problematic, but it could come out of it could well come to a significant increase in and a carbon tax in order to pay for the infrastructure bill, which is currently being debated and in Congress. Most likely, we're going to see some demand reduction as a result of these carbon reduction policies. How large it will be, you can see the wide disparity between business as usual policies and those that the goals that are have been stated in both the Paris Agreement, and we'll hear some more about new goals in COP26 meetings in Glasgow next week. The transition to non-fossil fuels, again, policy will depend on how quickly that can happen and whether investments in renewables and other alternatives to global oil and gas consumption really depends much on the investment and whether financial institutions see the fossil fuel industry as one that is worthy of further investments, and as well as the environmental policies to stop those investments. So a great deal of uncertainty, but I do think we are looking at a very strong upward pressure on price for both oil and gas winter 21-22 and perhaps well beyond that as an outcome of the pandemic's impacts on both supply and demand. With that, I'd like to thank Dennis once again for allowing me this opportunity, and thank you all for your kind attention, ladies and gentlemen.
Thank you for watching. If you are interested in watching all the presentations and the Town Hall Q&A meetings from this conference, please place an order by visiting OpportunityCrudes.com. As a reminder, Part 2 of our meeting, the 8th Opportunity Crudes Conference, will be held in person in Sugar Land, Texas in the U.S. during October 24-26, 2022. The event also offers remote or virtual attendance. The theme is Refining in Transition, from vision to execution roadmaps to provide the world with both energy security and a clean environment. The meeting anchors on 5 drivers. 1. Trends and outlooks of shifting global oil supply and demand. 2. Crude selection and trading, favoring low carbon and carbon neutral or carbon offset grades. 3. Crude management aids in refinery decarbonization. 4. Technologies that aid refining competition and sustainability amid fuel transformations. 5. UN Sustainable Development Goals in terms of Scope 1 and Scope 2 emissions for upstream and midstream sectors that facilitate the refining transition. If you are interested in sponsoring and/or presenting at this meeting in 2022, please contact us at info@opportunitycrudes.com.